Hello, everyone. Thanks for taking the time to join our webinar to give you an update on what we've been up to at Optimist. I have a lot of interesting things to share, I think, and some exciting news as well. First, I need to start with the most entertaining part of every presentation involving investment products, and that would be good old legal disclaimer. So please read this, understand that this is for informational purposes only, and please acknowledge reading this piece, and then we can hop into the fun stuff that I love so much talking about. Alrighty. All right, so what are we going to cover today? Other than this great picture of Vince Lombardi, one of the best football coaches of all time, that has just a great quote that I resonate so much with, is perfection is not attainable, but if we chase perfection, we can catch excellence. That is how I go about my day. It's fun to go after perfection because you're never going to make it, and it results in at least very good results. And so what are we going to talk about? Let's start with the review of the last 3 years. I can't believe that it has almost been 3 years since I started Optimist Fund. Time has flown. Then we're going to go into our view on the next 5 years, which I'm very excited about. Then we will jump into exciting news. People have asked me so many times, when am I adding someone to the team? So I have an update with that in mind. The closing of the founders class, and then we'll end it with some Q&A. I know many of you have some questions about some of my holdings, so I'll go through that in detail. So our beginning. Here's myself, Jonathan Bloomberg, and Sanjay Sen, my two partners that gave me the opportunity to start this fund. This is me when I'm much younger. You can see the hairline is much more intact in this picture as well, less grays. This was the day we launched on March 1st of 2022. We launched with a little over $6.5 million, and the fund from the very beginning and always the goal had a very singular focus, which I believe is very unique in the investment industry, ironically, and that you can read in my launch letter that I published at the time, which was focusing on maximizing long-term returns for our investors by investing in exceptional entrepreneurs that are addressing very large opportunities. They have significant skin in the game, and they're deeply underappreciated in some way. And so the mission of the fund from the very first day was bet on exceptional people, exceptional growth opportunities to produce world-class long-term investment returns. Pretty straightforward. Very happy with where we are today, but let's move on from where March 1st, 2022 was to how 2022 evolved, which was very interesting. So when I look back at it, I definitely did not have a horseshoe lodged anywhere because in terms of times to start a fund, I probably picked one of the worst times possible over the last 20 years. Right before we launched, Russia invaded Ukraine. People thought World War III was going to erupt. That caused a lot of supply chain problems that made inflation spike because of commodity prices spiking. And that created a significant interest rate hiking cycle that put everyone in a panic across the market. And so it was not a good time to be a public markets investor, not just a public equities investor, a public markets investor. So people honestly, they look at 2022 and you look, it's like, oh, it was a bad year, but it wasn't like the market was down 40%. But if you were to actually look at how the bond market did well, which the bond market was down as well, the 60-40 portfolio was absolutely horrendous. So it was a very, very tough year to start, but it created so much opportunity that the strategy, how I created the strategy with being focused on maximizing returns over the long term, gave me the ability to really make some investments that I thought was going to do exceptionally well over the next few years. And so 2023, at the end of 2022, I couldn't tell you how many times people were telling me to get more conservative, and that 2023 there was inevitably going to be a recession. Things were definitely going to get way tougher, and that was just broad comments. Then let's go into the companies that I focused on at the time. So I focused on ambitious businesses. And those ambitious businesses can be viewed as risk assets because they're investing a lot today to make a lot more money in the future. That's what ambitious people do. They make investments today to make way more in the future, generally speaking. And so that area of the market got absolutely decimated. All of a sudden, every business that was viewed as a digital growth-oriented company was getting lumped together as some sort of garbage business model. As you can see here, like this article is just saying Snapchat, Netflix, Uber, they're all the same. They're all digital business models that had bad fundamentals and they just got absolutely hammered during this period. And then a company that I also really liked, people then decided, oh, the business model is completely flawed. They will never make money. Trust me, I'm a car dealer. I've been in the business 20 years. Trust me, I've looked into Carvana. I know they're doomed. That's what everyone said at the time. As the year progressed, it went from the business model's flawed to, oh, they're going to go bankrupt. Not only is it flawed, they're imminently going bankrupt. And then by the end of the year, it wasn't even that, oh, maybe they go bankrupt. It's why did they fail? The business, so people were concluding that failure had already happened at this time. It was truly a very unique time that created enormous opportunities that I was very focused on. And so I positioned the portfolio to benefit from some of these enormous dislocations that I viewed as either transitory or some of the commentary was actually just flat out factually incorrect. And over time, that would be proven. And if you go back to our Q3 2022 letter, you could see, the first 7 months, we were down 50%. Not a nice start in the context of launching a fund. I can only imagine what Sanjay and John may have been thinking at the time. But it was such a incredible opportunity, and there was no swaying of that. There wasn't going to be a massive rebound. I could see that in what was happening with my companies, and then you could also see it in like broad risk appetite. So there's surveys like this one right here that I had in the Q3 2022 letter that showed portfolio managers how much risk they were taking relative to usual. And so you could see at this time, people were more fearful, taking less risk than they were at the bottom of 2008, early 2009, when people thought like the financial system was collapsing. So everyone was running from the hills from anything associated or deemed a risk bucket, which just created enormous opportunity. And our unpopular decision to buy more in late 2022 and 2023 ended up working out very, very well. So Carvana, as I said, was one of our very unusual situations where the stock, our first buy was $128. We bought more at $60. And then people all of a sudden thought they were done, and it went to $3.50. We bought all the way down to $7. Our average cost got to around $30. And now it's a $250 stock. So that is not just because market sentiment is back. That is because they went from having negative EBITDA margins to now having over 10% EBITDA margins. They are the most profitable used car dealership in the world, and growing the fastest as well. So the fundamentals, the things people were saying, were wrong. And we were able to take advantage of that. And it wasn't just Carvana. The same thing happened with Uber. Everyone was saying how the business model was never going to scale. They've been at it for so long, haven't made much money. Stock sold off a lot. Has rebounded significantly. Free cash flows exploded. The business is highly profitable now, growing at a good rate. Very clear that it's a high quality company. And DoorDash, was the exact same thing. Oh, all these businesses spent so much to acquire all these users. They did it irrationally. Again, it was such surface level criticism of the business model that it was clear. If you just did some digging, you'd realize that there is a lot of embedded cash flow generation that this business can generate. And so just give it time and you will see it. And that's exactly what we've seen over the last 2 years. And so volatility, and when I started this fund, I was very clear is risk does not equal volatility to me. Volatility is something I'm going to use to my advantage to enhance the returns of the fund. And that is exactly what we've done since launching. So since launching, after having the tough start, we've now compounded at 19% annualized since inception. We're up about 80% year to date. In the last 12 months, as of November 30th, we're up about 115%. 2 years, we've compounded at 74%. And since inception, it's 19. And so if you invested $1 million on the first day, we would have had this situation where everyone was saying the world was going to end. We were positioning the portfolio to make it so that when inevitably the world does not end, we make a ton of money. And that's what we've done. And that is what I am very focused on doing, is taking advantage of these moments where everyone gets defensive, everyone's scared, and I'm going to focus on the fundamentals that's going to maximize the amount of money we can make over time. And so the absolute performance has been good, but the relative performance actually has been really good. So as I said, we were up 80 this year, up 80, 83 last year. 2022 was the horrible year. Other growth managers, you can see here, US peer group, when I think of the most well-known best growth managers in the world, like Ron Barron comes to mind. Dennis Lynch at Morgan Stanley comes to mind. There's several. If I look at how we've done relative to that basket, we've done very well. And frankly, the reason for that is that we did not get conservative at the bottom. We didn't all of a sudden change what we did. We didn't all of a sudden focus on the next 6 months or the next year. We continued to focus on maximizing returns over a 5-year basis, and that allowed us to do much better as things turned. And so now, we're almost 3 years in. So it's been 2.7. We're being very specific, which I typically am. 2.75 years in, and compounded about 19. But and a lot of people I hear today are talking about how the market's frothy and there's not a lot of opportunity in equities, and more things as to why everything is fully priced, and that I'm sure that's the case with many companies, but I'm seeing a lot of opportunities still that I think are very attractive asymmetric bets that are going to make us a lot of money. And one in particular that I've been adding to a lot in the last 6 months is HelloFresh. And so I'm sure many of you have bought from HelloFresh before, just the core meal kits business. It's saves people time of thinking about what they're going to eat, gives them ingredients in a box, then they cook it. This core piece of the business was the beginning of it. Just the meal kits business was what they were doing. They started in Germany, expanded to different countries, and the business model worked. They grew rapidly. Their margins expanded dramatically. Even pre-COVID, Germany was a high single-digit EBITDA margin business. So the business model worked. It was a good business. But then COVID happened, and it made the business become much more profitable, much faster, because there was just such a inflow of demand. And at the same time, they bought another business called Factor 75, which is a ready-to-eat business. And so this next phase that they went through was COVID really juiced the demand on the meal kit side, and then lapping that became challenging. So the meal kit business started to decline, but the ready-to-eat business was scaling dramatically. And so they were applying the same playbook that they applied to the meal kit business of marketing, fulfilling customer demand, people being happy customers, reordering, and then taking that profit and expanding into other markets. They were doing the exact same thing with Factor, which made it so that their revenue actually was roughly flat, but their EBITDA margins went from nearly double digit to 5% as the meal kit business was starting to decline. But then Factor was earlier in their maturation. And so since it's a subscription offering where you subscribe to Factor, you get a certain amount of meals a week, and then you can skip weeks or keep getting them every week. Because of that, you're going to invest, more than your first weeks of profit in getting that customer. And so if Factor's growing really fast, it actually was like negative margin, but as the growth slows, the margins are going to ramp, similar to the meal kit business. But because of this mix effect, they kind of had this like sideways period. And then put on top of that, they were really still committed to telling people that the meal kit business still had growth opportunity left in it. And we're still really trying to invest to get that business going. So they were putting more pressure on margins because of that. And it was only until the beginning of this year where they have now fully decided that they've accepted that the meal kit business now is a global near monopoly business that is highly profitable, that they are going to focus on just maximizing its profitability. And the ready-to-eat business will be the core driver of the business going forward. But now that the ready-to-eat business is much larger, we're finally at a situation where revenue in aggregate should, over the next couple of years, grow again. But more importantly, and the thing the company is squarely focused on, is they want to get the margins back up to that close to that 10% double-digit EBITDA margin period. And when they do that, we are going to have an enormous windfall of annual free cash flow generation that is dramatically underappreciated today. And so I think this stock can be a €100 stock. Today it's about 12 euros. It got as low as €4.50. And over this time period, the insiders have been buying. The CEO actually recently took a $10 million loan to buy more stock in the public market. And the last 3 quarters, what we've consistently seen is revenue coming in line, but profitability being significantly better. And so there's a lot of similarities, frankly, in my opinion, with this thesis and Carvana, in the sense that right now people are applying such a low valuation to this company because they don't think they can grow profits. They think profits are going to continuously fall off a cliff. And that's actually the one thing I'm incredibly confident in. Like, I'm more confident that they can get to 10% EBITDA margins, possibly at no revenue growth, than I am that they can grow 5% revenue and 10% EBITDA margins. But just to get to 10%, we're going to, the valuation of this business is going to go up dramatically, because right now it's about 3 times EBITDA, and a grocery store, which is obviously a very mature business that doesn't have much growth, is typically 7 or 8 times EBITDA. So this is right now the second largest holding in the fund, and one I'm very excited about. Carvana, I've spoken to you guys a lot about, for good reason, because of what has happened to the company over the last 3 years. It's been truly transformational. in short, the business is such a good business that still, under, even though it's obviously now a $250 stock and people don't believe it's going out of business, it's still dramatically underappreciated how good of a company this is and how difficult it is to compete with them. And so to build out Carvana's infrastructure would cost $10 billion. And today they have roughly 80% market share of used cars that are bought online, fully transacted online. And the penetration of online in the United States is about 1%. And so the reason it's 1% and not 10% is not because people don't want to buy online. It's because franchise dealers and independent brick and mortar dealers have been doing business a particular way for a long time, and they have not built out the infrastructure that is optimized for selling cars online. So they are not trying to push online adoption. The only person that is trying to do that is Carvana, because they're the only pure play online car dealer that survived. And so they have an incredible market position that is still underappreciated. Like, even if you look at how many people have a buy, hold versus sell, like, still the majority of analysts do not have a buy on this company. And I think this will become, a consensus long, like a Google, or a name that, you look at typical, very quality centric portfolio managers, like, none of them are buying Carvana right now. And it's because it still seems too immature, and the improvements of the economics they need a couple more years to really like show in the financial statements how amazing this business is. And that's the direction we're going. That's why it's still the largest position. Yeah, it's just an incredible company that I hope we own for a very long time. And then lastly, in terms of the three companies that I'm just going to highlight, is Wayfair has been the one that I've spoke to you guys a few times over the last, I guess, year and a half is when I started doing these webinars about how excited I am for Wayfair when the home goods market finally rebounds. And unfortunately, I've been saying the same thing for nearly 2 years now of when it rebounds, they're going to do really well. They're going to continuously gain a lot of share, and their incremental margins are going to be very high, which is going to create an explosion of profitability, which is this phase 3 period that I am waiting for. And it has not happened yet, but the core business, while we wait, is getting better. And so they've done a great job improving their margin profile. They've become more efficient. They're still gaining market share. They're at all-time high market share levels. We're just waiting for that time where the consumer finally decides to refresh the patio furniture or just start buying home good items. And it's going to happen at some point, unless we're all just going to, stand on a go-forward basis and no longer buy chairs and coffee tables, etc. So it is going to happen at some point, and I think it's going to happen. I think it could happen next year, especially with interest rates coming down. But it's going to happen in the next couple of years, and when it does, it's going to be very good for this company. And so it remains a large position, and I think the upside here is very meaningful because people are still not attributing. Like, this business invested a lot of capital to build out a really, really like high quality business. Frankly, they have a lot of infrastructure that can create a very good customer experience that they're going to show very strong incremental margins on once they grow again. But we just haven't seen it. So I think it's gonna be similar to like Uber, where when Uber had marginal free cash flow, people were saying, in theory, this thing should make money. And in theory, the incremental should be awesome. But we haven't seen it yet, so I'm not going to give them credit. And then when it happens, all of a sudden people say, "Oh, this is actually a really good business," and all this capital they invested over the years it actually made sense. I think a similar situation is going to happen with Wayfair. And so I am very bullish over the next 5 years. I see still really, really disproportionately attractive opportunities in the fund. Even though, market's at all-time high, like, I think a lot of that is disproportionately attributed because the mega caps have been so loved. But if you look at in the mid cap area, there's a lot of businesses that are still meaningfully below their previous highs, but their businesses are much, much better. And so I'm very excited for what the risk reward characteristics of the fund looks today. As I've gone through many times previously, like I really think about things from, if I'm right on how it's going to work out, how much money do we make? If I'm wrong, what's the return profile? If I'm more than 50% right, we're going to do really well. And so you can see if I am 100% right, the portfolio would compound at 40%. If I was 100% right on my downside case, it would be 6%. In reality, it probably falls somewhere in the middle. So I think we're going to do very well, and I'm very excited. Now we can shift to the new portion of these calls that I've been doing, because obviously I have been going through the portfolio historically. Now we add another person to the mix, so it's just not me talking into the void here by myself, which will be nice, and I'm sure a more pleasant experience for you guys too. So the person that, so the most common question, as I said, am I going to add anyone to the team? Like, can I do all this by myself? Am I going to add someone? My philosophy on this has always been, like, the strategy is very concentrated. 80% of the fund is in my top 10 holdings today. So I am very well equipped to keep picking stocks, and I'm not looking to hire a team of 6 people to generate all these ideas for me. I love doing that. I love finding ideas. But I'm always hiring for a really, really great person that can make Optimist Fund better and increase our long-term returns. At the end of the day, that's all I care about, is maximizing our long-term returns. And so if I can find someone who can do that and help with that, then I am very, very happy to partner. Clearly a Buffett quote here. There's no such thing as an investor presentation without a Buffett quote, let's be honest. And so who's joining is the person who hired me, who I used to work for at Cambridge, is Brandon Snow. Funny story. So Brandon Snow, he went to Laurier. He co-opted or interned at Gluskin Sheff and Associates. And then he went to Boston and worked for Fidelity. Rose the ranks there, became a portfolio manager, was very successful. Then he went from Fidelity to joining Cambridge Global Asset Management, which was a division within CI. When he joined, it was about 2 to 3 billion of assets. Over the preceding decade or so, it grew to 20. I think at the peak we were 25 billion in assets, and I joined, and he hired me when I was just out of school in 2014. But the funny thing, a funny little side story here is that, so when I first got interested in stocks was when I was 18, and one of my friends was going to Laurier at the time, and I was like, oh, like I want it, like we were talking about stocks and whatever. We knew nothing, and okay, where are places that I could go where become a portfolio manager? And he was like, oh, you should come to Laurier. There's like this Laurier Student Investment Fund. People who go there then get like co-ops at shops in Toronto, and then goes on to like become a portfolio manager and whatnot. So I was like, okay. So my friend, who's funny enough to launching a fund now, he sends you this brochure, and the person on the front of the brochure was actually Brandon in like 2001. And it was like, talking about how he co-opted at Gluskin Sheff and then was now at the time a portfolio manager at Fidelity at like 29 or 30 years old. So I was like, oh, okay, well, that's clearly like a blueprint there of like someone has done that at Laurier. That's what I'm going to do. So then I went to Laurier, joined the Laurier Student Investment Fund. I co-opted Gluskin Sheff, but then on my first term as a co-op, Brandon, I think it was his first year back in joining Cambridge, I reached out to him, and that was the first time we had interacted. And then after, when I graduated, is when Brandon was able to hire me. But it was it's such a funny it's a funny web of like, making you realize how things you do when you're like 20, 18-year-olds can be like looking at that 10 years later and be like, oh, I'm going to try to do that as well. So let me Brandon's now on. Brandon's here now, so we can have him join and chat a little bit about what he's been up to.
Okay.
All right, I see him.
Hello.
Hey. So, I think an interesting thing to start with. So you were at Cambridge for almost 10 years, I think. Correct me if I'm wrong. And then in 2020, you decided to retire. You were not born in 1932, so it seemed like you retired somewhat early. Like what was your thought process there? Like why did you retire so early in your career?
Yeah. Yeah, I think that's an important question. I'll just say hello to everyone and thank you for listening in. Um, a lot of people thought I was crazy at the time when I decided to retire. I think there was very few people, only the ones that are really close to me, who were like, okay, you're making a good decision for yourself and we're happy for you. But when I originally got into investing, it was 2001. I did a co-op term at Gluskin Chef, and it was my first real insight into how the business works. And I absolutely fell in love. I mean, for me, investing was a massive competitive space with a tremendous amount of information to analyze, things to learn. And if you could draw the right conclusions, find the right angles, you can actually come up with interesting opportunities that no one else has seen. And that ability to have that, aha moment when investing was something that was, tremendous. And it's really what drove my passion all the way through Fidelity. And when I left to join Cambridge, that was the plan. The plan was I would work with Alan Radlow. We would do the investment side. We hired Bob Swanson at the same time. He came on with us over to the firm, and Bob Swanson would be our marketing guy, right? So my view of my future coming into Cambridge was I'd still get to do investing. That'd be, 90% of my job, whatever. So within, I think it was 2 days of announcing that Bob and I were joining, Fidelity filed an injunction against Bob joining. So basically put him on ice for 6 months. And CI was like, oh, there goes our marketing guy. Who can step in? Alan refused to travel. And Steve Groff and Greg Dean at the time who joined with us were just too new, too young, obviously. And so I had to become the marketing guy. And I was never a sales guy. It was not my thing, right? I actually had like an intense fear of public speaking at the time, but CI was making a big investment in us, so I had to go along with it. And then a couple years later, we wanted to invest in the firm to grow it. Alan didn't want to because he was looking like he wanted to retire. So we worked out a plan for him to retire, but that meant someone had to be CIO. And again, Bob Swanson, he does the asset allocation, he does the marketing, a great guy, but he was never a bottom-up stock picker. So that fell on me. So what I found was coming over to CI, just, based on circumstance over the years, less and less of my job was applied in the space that really brought me energy, that I really had passion for, which was just the pure investing. And as time went on, I realized that I wasn't engaged. I wasn't energized like I used to be. And at the same time, I had some stuff at home I had to deal with. My kids were of an age, a couple of them were having some issues, and I needed to be more present for them. So kind of falling out of love with the job as it became and those responsibilities I had at home really came together to make me think, okay, I've had success. We're happy where we are. I never, lived a crazy luxurious lifestyle, so I had lots of money saved, and I decided to walk away and just kind of do what I wanted to.
So what's that been then? I guess that's you've been doing whatever you wanted then for the last, I guess, probably 4 years it's been.
Yeah, I'd say about three and a half years. So really, I left and I completely left markets. Like I detoxed. I sold all my funds. I sold all my stocks. I put all my money in bonds. And I said, I just got to get away from this space because I was really soured on it at the time.
Mhm.
Um, we had been traveling to Costa Rica for many years as a family in the summers. So we decided to build a house in Costa Rica and move down there. So before I moved back to Canada earlier this year, we were living in Costa Rica for about 3 years. I took up surfing and I was spending a lot of time on areas of interest, just things I was curious about. So I did an astronomy course, I did a sense making course, I did a philosophy, cognitive science course. Um, and I spent a lot of time reflecting on myself, like who I was, who I became, blind spots I had. Um, uh, Deficiencies and just trying to understand myself in the world and my place in the world a lot more. So it was a lot of reading, doing courses, spending time surfing almost any day I could. I would be out there. So really taking care of mind, body, and spirit. And then probably after 2 years of that, it was kind of like, sometimes you get like 90% of the way there and you start seeing diminishing returns, of incremental work
Yeah.
you're putting in. And I
Yeah.
was like, I got the itch. I got to do something. And so that's when I started looking at markets again and looking at stocks and started investing my money a little bit and really coming at it, back with that original passion I had. Like, unconstrained, no bureaucracy, no
Yeah.
politics or ego involved. Just like, okay, well, what's going on out there and where are the opportunities set?
Yeah.
Um, and so my kids were getting older, into their teenage years, and we decided we didn't want them to be beach bums for their whole life. So we decided to move back to Canada. And we relocated earlier this year, actually, to KW.
That's great. And then this was because when we met, I think it must have been in summer of 2022, or maybe it was early 2023. We grabbed lunch,
Yeah.
and obviously you've been, very impactful to my career, and I always really enjoyed working with you. And so I was scheming in my mind, thinking someday Brandon's going to come back to the industry in some capacity, and uh, whoever he's going to do something with, he's going to help them out immensely. And so that's when I planted, I think it must have been early 2023. I planted the seed of saying, if you're ever interested in helping me build Optimist or whatever you'd be interested in the investment world, I would love to do something with you because I think we'd be a great team. And so then you moving back to KW earlier this year, like what was it about Optimist, I guess, that coming back to the industry, why is it that you wanted to join Optimist versus, go work at like McKenzie or another mutual fund company, which is like traditionally where you had worked?
Um, well, I came back and knowing I wanted to find opportunities and just kind of having an open mind and seeing what came my way. Um, you know, I did not want to get back into the bureaucratic sort of structure of like typical companies. There's a
Hmm.
tremendous amount of inefficiencies in the mutual fund space. And um, again, it's what I left, right? What I ran
Hmm.
away from. So we started working, first of all, Jordan, like I always thought you were one of the best investors I ever worked with. I think you have um, a tremendous analytical ability, understanding of business models. But what sets you apart from what I've seen is that you have a very good temperament for investing. I think a lot of people get ego attached to their ideas where their persona almost becomes, the stocks they own. And I find you're very pragmatic. You're like, this is a great opportunity, but if the stock ends up being a piece of shit, it's a piece of shit. Like move on,
Yeah,
right?
it's true.
Like that's fine. And I think that temperament is something that very much attracted me. And then along with that, so as I was doing my, studies and, my philosophy courses, there's this concept I came across called the dialogos. And So dialogos is in comparison to either debate or dialogue. And the best way to think about it is, analogy is with kingdoms. So, a debate is two kingdoms at battle and one trying to conquer another, right?
Mm.
And it's very reductive. Like someone wins, someone loses, net, it's a negative.
Mhm.
A dialogue is like an exchange of ideas. So it's almost like two kingdoms that have maybe a trading relationship, maybe mutual defense agreement, something like that. But they're still apart, right? So
Mhm.
they're providing information or whatever it is, the resource back and forth, and that can be somewhat of a positive, but it's not really a step function change, it's just sort of like a bit of an optimization.
Okay.
Now, dialogos would be when two kingdoms come together and they actually integrate. And what they find is that they can actually transcend what either of them were and go to a next level. And the dialogos is something in a conversation that I've been looking for after doing the work in philosophy. I want that sort of interaction. And it's a situation where you come together,
Mhm.
two people come together with ideas, they share ideas, they integrate ideas, but with the play and the conversation with those ideas, you're not just, 1 + 1 = 2. You're actually leveling both up. You're looking
Mhm.
for that transcendent sort of aha moment, that
Mhm.
information where individually you couldn't get to, and one just consuming the other couldn't get to. It actually has to be a combination together. So when we started meeting just to talk stocks, whatever it was, May or June of this year, that's what I found. I found, we'd sit down for 3 or 4 hours, go through stocks, talk about portfolio construction, whatever it was. And it was really that sort of, the ideas or the deeper truths that came out of it were beyond both of us. And they just kind of
Mhm.
emerged from the conversation. And so that's something that's tremendously energizing. That's what we want to
Mhm.
find. And
Yeah.
so and I think it was very effortless because we were kind of like, oh, let's try this out, see how it goes. We did it. We're like, yeah, this is great.
Mhm.
It's working.
Yeah.
And then we're like, oh, yeah, I think it's time to formalize the situation. Yeah, for sure. Um, Again, without ego, without politics, without nonsense involved.
Mhm.
Um, and that's why I'm, very happy to join. I think it's going to be a tremendous opportunity. I think I have a lot of knowledge and experience that I can contribute
Mhm.
to the
Definitely.
organization, to the fund, and I think that'll result in better returns over time. Not that they've been bad, but I think
Hey, they could always be better. They could always be
we could be
better.
better. Yeah, exactly.
There's mistakes have been made. We could do better. And we're definitely going to focus on doing whatever we can to do that. Well, great. So now that you are joining, if anyone has any questions for Brandon or wants to chat with him at some point, you can reach out to me and we can forward it over to Brandon. Or if you have questions, we're doing a Q&A. I need to get through a few more slides here, and then we'll hop to Q&A. So you feel free, but thanks for sharing that, Brandon, and we'll bring you back on Q&A if anyone has any specific questions for you. Oh,
Great.
okay, that was there. There we go. All right. I'm very excited about that. Very excited about Brandon joining. All right, where were we here? Okay, so now to the founders class. This is I know I've been talking about this founders class for a long time. I get it. I'm sure you guys look at your LinkedIn every month. You're like, we get it. The founders class is closing. But there's a little more than 2 weeks until we are closing the founders class. And so if you are considering investing, if you're on the fence, it makes sense to do that. Do that in the next 2.5 weeks, because after that it will close and we will go to our regular pricing on a go-forward basis. And so to conclude, launched almost 3 years ago, 6.5 million in AUM. Now we're 30 million. We're scaling. The strategy is not a microcap strategy. My average market cap is a little over 20 billion US. The capacity of this strategy is 2 billion US. So we have a lot of capacity to scale, and that is what we are starting to do now. Now we're roughly 3 years. The performance has been very strong. I don't know. I don't know many funds that have had better performance, but if there is one, please shoot it my way. I'll add it to my list. I hope seeing Brandon join, gives you context for how I'm thinking about building this this company. Is that I want exceptional people. I think the word was dialojo. I'll have to correct, but like that in my mind is like that's when you add someone. You add someone when it's not 1 + 1 = 2. It's 1 + 1 = 3. And so I'm always looking for people that are going to have that step function increase so that we, over the next decade, will be a collection of very high performing individuals delivering exceptional results for clients. That is the goal. I am very excited with the portfolio. I know some people would look at what happened recently and think that, oh, did I miss it? Have some sort of feeling of, am I buying at the top? Like, HelloFresh is down 88% from its all-time high, and the business is in a much better position today. Latham Group, which is a company I profiled in my most recent letter, is down 65%. Their industry is absolutely at a cyclical trough of manufactured pools. They are going to have tremendous growth over the next couple of years, in my view. So there are a lot of very attractive opportunities right now that I think is going to make us some solid returns over the next 5 years, and I'm very focused on capturing that. And then, we're closing the chapter on being a startup fund that, has no track record, that just started with a couple $1,000,000. Now we're entering a new phase. And I just, want to thank everyone who has invested when I was this startup phase. I know some people who invested in the early days. I can't express the level of appreciation I have for people betting on me, on day one or day two, like so early on when I didn't have a track record and really you were just betting on what I was telling you. And so really appreciate that. And I'm very excited to keep making you a lot of money for decades to come. Now we will switch it over to Q&A, and you can put a question through the Q&A section on Teams, as well as if you want to send me an email too, that works too. I have a list of questions people have already sent, but it looks like we already have one here. Do I have any thoughts on Waymo? Yeah, so we own Uber. I've been an Uber bull since we launched. They announced that they're entering Miami through their own app. And how is this going to impact Uber materially? Seems like everyone's getting worried about this. And then you have the Tesla autonomous element as well that is like creating incremental fears around Uber. So it's a good question. So the first thing I would say is we are very, very early in autonomous. So like Waymo, who is by far the furthest along in the autonomous world, is today in San Francisco, Phoenix, and LA. There are 3 cities. So it is incredibly early. And Uber thus far has been going the partnership approach. And so a few months ago, Waymo announced that they're going to enter Austin as well as Atlanta in 2025. 2 new markets that they're going to commercialize in 2025. So they'll go from 3 markets to 5 markets. Of those 2 markets, they're going to market exclusively through the Uber app. And so in San Francisco and Phoenix and LA, they are available. Well, in Phoenix are available in Uber as well, but they also have like the Uber or the Waymo app that you can go direct with. So people are increasingly getting worried that if autonomous proliferates across the world and everyone uses autonomous and it lowers the cost, that it makes it so that the Uber platform is less relevant. And then Waymo decides, oh, we don't even need Uber. We're just going to do it all direct and cut Uber out. Then Uber's rideshare business is now going to be worthless. And so what I would say to that view is, number one, we are so early in the journey that that is an absolutely enormous leap today. And especially since when we look at how Waymo has been going to market, two of their markets they're entering now, they're doing exclusively through Uber. And so why is that? Well, the reason is because demand utilization, like getting the car used as much as possible, is very important for economic returns and for the customer experience, rather. And because Uber already has so many people and so many drivers, tucking in Waymo within their fleet is a very it's a good customer experience, and they can create higher utilization rates than Waymo can by themselves today. And so so one element is like the developments we're seeing now are actually positive for Uber. So the fear right now is purely people saying, oh, but like they're not going to do it at some point, and then it's all going to go to Waymo. Another reason why that's really going to be challenging is that why Uber is so good is that you have so many people that bought their cars where they can incrementally enter the supply for 2 hours out of the day. And it can be an economic opportunity for them. And the vehicle they already bought, so is largely a sunk cost. And so when you think about how often people want a ride hailing service, you have very steep peaks. And so now Waymo could obviously have vehicles that are constantly being utilized and hitting some level of demand, but to address the peaks of demand, like right after work or right in the morning or later at night, like there's like specific peaks, to address that is going to be best done through a hybrid network between existing drivers and an autonomous fleet. And so I believe that Uber's network today is incredibly valuable. And even with Waymo scaling in these markets, which will be inconsequential to Uber's P&L right now, although like Uber's getting revenue from it because it's a direct part, like those two cities they're entering next year are a direct partnership with Uber exclusively. It could end up being a bull case, frankly. So in my view of like what the scenarios over the next 5 years are, it's in the worst case scenario where all of a sudden Google decides to raise $100 billion and deploy autonomous vehicles all over the world in a span of a year, which I actually don't think is possible, but let's just go pie in the sky. In that scenario, Uber's US ride hail business, you could put at a zero, you could literally take it out of the business 5 years from now, and their profit is still going to be larger at that point than it is today. And right now, it's like 15 times free cash flow. So like I actually view it as worst case scenario, I don't think we're going to lose money. And the good scenario is autonomous is actually going to create more supply for on-demand transportation. And Uber is going to be like the Google aggregator, which will be very beneficial to them. So that's how I'm thinking about it right now. But I'm very focused on tracking this because it is so early that it's something that like we're going to be talking about for a long time. We're not going to have like next month and also be like, oh yeah, this is not something that could end up having a negative impact at some point. All right, Ahmad Khan. With regards to HelloFresh, is Factor's customer acquisition costs coming down significantly to justify the rise in adjusted EBITDA? No, that's actually not the driver. So Factor's profitability is improving dramatically because their gross margins are improving. So Factor at the end of last year opened a new facility in Phoenix that is the second largest commissary kitchen in the United States. And scaling that was challenging, and it made their gross margins compress. And so now that business went from being a high single-digit EBITDA margin business to -4 actually in Q4 of 2023 and Q1 of this year. And now that is back to mid-single digit, and it is scaling. And so Factor's business right now is all about continuously growing. Right now it's growing 40%, but over the next couple of years, I think it can keep growing 20% plus. And then the gross margins improving by the utilization of that manufacturing facility growing. What else we have here? So given the run in Carvana, why does it still make sense for it to be the largest holding? Yeah, so I elaborated on this a little bit on just there are a lot of analysts that are still underappreciating how profitable this business is going to be. They have spent $10 billion to build out an infrastructure that can sell about 8 times the amount. Well, they'll have to put in another $1 billion likely over the next 5 years, which frankly, relative to the $10 billion total investment is not that big. But so they put an incremental billion on the 10, and they're going to have an infrastructure that can sell 8 times more cars than it does today. And so the operating leverage of this business is going to be enormous. And people, again, so many analysts who just turned their back on them when they were going through tough times, still are just not giving them credit for how good of a business it is now and how favorable the competitive dynamics are. And so, yeah, I mean, it's not going to always be the largest position. If it was $900 tomorrow, it would be, I would sell it, frankly, if assuming all things the exact same. But as of right now, I still think it's very attractive, and I can, we haven't even hit all-time highs for this company, and like it is dramatically better than it was in 2021. Like just it's night and day. There, you really cannot compete with them selling cars online now. Um, where can I buy the fund today? Yeah, so that has been something I've been working on. Today, we are approved on RBC DS. That is the only platform that we are officially approved on right now. So every investor is either buying it through RBC, an independent financial advisor that taps into the National Bank network, or coming direct to myself or our ops team. But over the next year, I'm very hopeful that we will be expanding distribution and be on, CIBC, the other bank platforms, Richardson, some of the other big independent platforms as well. We've been in discussion with them, and I think over the next year we should get approved on those platforms. But I will be sure to let everyone know when that does happen. And we are just about at the top of the hour, so I just want to, doesn't look like there's any other questions. Let me see. Oh, wait. New post. Oh, here we are. In your view. Oh, okay. So another one here. Oh, geez, I missed some of these. Whoa. All right. Note to self, improve my ability to scroll. All right. Is the fund approved and bought at CIBC? Yeah. So right now not approved on CIBC Wood Gundy. I've been told that you can, if a client is a client of CIBC Wood Gundy, they can ask their advisor to place an exceptional trade and buy the fund. So I've been told that is possible, but it is not yet approved to the point where like a PM who's running a discretionary book can allocate to the fund. Hopefully that will happen in the next year, but it's not there yet. Another one here. Curious about Brandon's role in dealing with Jordan over the past few years. What do you think you'll bring to the process? Risk, mistake avoidance, portfolio construction, position sizing. I'm sure you already have a chemistry, so how do you think it changes the fund's management? It's a great question. I will let Brandon comment on this for things that he thinks he's going to be able to bring to the table. Disable mic too. Can we see you?
I think
Can I hear you?
Yeah, camera is disabled, but it's fine. You're not missing much. Yeah, thanks for the question, Curry. Appreciate it. What I see my role with the fund is to continue to let Jordan manage it, but really be sort of, his Socrates, ask him questions about companies, ask him questions about positioning, watching out for, aggregate exposures maybe he doesn't see. It's sort of like a second set of eyes. And I think filtering through ideas, both analyzing existing ideas and looking at new ideas, is something that with my knowledge and experience, I can really speed up that process with Jordan. I think that, obviously the desired outcome is better returns at lower risk. I mean, that's really what we want to achieve at the end of the day. But when I think about the impact of the portfolio itself and the portfolio management, I think it's really just optimizing the management of the portfolio, bringing my 12 years experience of running funds of all sizes really to bear and help Jordan with positioning and ideas and sort of balancing new ideas coming in and adding more to existing ideas. So I hope that's not too nebulous. But I think it's just having a second set of eyes on things. Someone can ask questions, can challenge ideas, and then work together to, like I was saying before, like find that higher truth of what's actually going on out there in the market and capture better opportunities that way.
Yeah, I'm very excited about it. And I definitely, even with our discussions that we've been doing since we first started really working together earlier this year, I can already like it's already been helpful. And I think it's already driven better decision making in some circumstances. So I'm very, very happy about it. And I know we are going to do better together than I would do individually. Though I do think I would do well individually to be fair. Like, but Brandon will make me even better, and I'll make him better too. All right, thanks for the question, Mike. Adam here. Carvana was an amazing pick. Clearly, any stocks on your radar or in the fund that you could think could have similar growth in the next 12 to 15 months. Oh, I have one. I do have one. I will. Other than good fundamentals that the market is getting wrong, I guess. Okay, so I already told you two, which was HelloFresh and Wayfair, but one that I'm particularly interested in right now, I'm not going to spend too much time on it, is a company called ThredUp. They do secondhand clothing, and the thing that's unique about this business is maybe some of you know, like Facebook Marketplace, people buy and sell secondhand clothing, or people have Instagram accounts where they're buying and selling secondhand clothing. There's Value Village, there's Goodwill. Secondhand clothing's been a thing for like a long time, but it's increasingly become more trendy, like in the last 10 years. And there's a lot, and there's like a Poshmark, there's a company called Depop. There's all these different platforms where people are posting stuff and selling them, and the marketplace is charging like a 15% commission or a 20% commission as like a demand generation fee, pretty much. ThredUp is very unique in the sense that they focused on like a niche where they actually are a managed marketplace where they send you a bag and you fill the bag with a bunch of stuff that you don't want anymore. And then they take that bag, bring it to their warehouse, empty it, figure out what's junk, what could be useful. The stuff that's useful, they have to put it on a mannequin, take a bunch of pictures. Then they have a single SKU or like a serialized distribution center where every single item is unique. Like if you think of Amazon, it's like it's SKU based, and then there could be like a lot of like you have one computer and you have 1,000 in inventory of that one computer. But if you're selling Lululemon pants that are black and have a slight, like, I don't know, some sort of like tarnish on one area of it, that is like a very unique item. And so it needs to be, they had to build out these warehouses that were based on like all unique items. And this business went public in 2021. It went public at this like high valuation, had this interesting concept. They were burning capital. Then obviously 2022 happened. Everyone abandoned it. They're like, this business sucks. Stock got absolutely crushed. But they really improved. They really grew into their fulfillment infrastructure and actually had like 40% incremental margins for the last 2 years. And at the beginning of this year, finally got to right around free cash flow break even. Then this summer, they had 20% of the revenue was in Europe. And they had this disastrous situation where Europe all of a sudden, the US was doing great, and all of a sudden Europe was like a problem child, and they decided to divest it. And that made the stock get absolutely hammered. And now they've divested Europe. The US business is, I think, on the mend. It's free cash flow positive now. They have about 40 million in net cash. This is like a small company. It's like 180 million market cap right now. So this is definitely like at the very end of the low end of the range. But it's an interesting one that now if they get back to the 40% incrementals that they were showing for the last 2 years, over the next couple of years and get back to like growing top line and like a 15% revenue growth rate, like you could see a scenario where this business is generating over 50 million of free cash flow in a couple of years, and it's 180 million market cap. So I would say that's one where, like, you know, I take your question as what's something that can go up like 8 times or something. Like it's not going to be like a 20% compounder. It's going to be like, yeah, there's a lot of juice to it, and I think ThreadUp could be that. But we'll see. I've got to track it obviously, and I'm very bullish on it currently. But again, if it ends up not being how I think, then obviously I'll make adjustments and make changes. But that's one I think could be interesting. And last, okay, so we're 6 minutes over. So one more question from Matt Burke. In your view, what will be the catalyst for investor sentiment to shift from autonomous is a massive threat to being it is not a threat? I don't think people are going to all of a sudden say it's not a threat. But I think if they keep delivering on their numbers, which is like free cash flow growth above 35%, keep growing top line in the mid-teens, showing really good incremental leverage, and they keep and like nothing, everything's, there's no, oh, we went into this Waymo partnership and we screwed something up and it went horribly wrong and it like impacted our financials. I think if things just keep going as they're going, people are just going to be like, oh, this is still a threat. We have to watch it. But like Uber's executing really well. It's still growing at an attractive rate. It's a really cheap stock. They're buying back a lot of stock, and it's just a really high quality company. Like when you think about Waymo valuation at their most recent equity round was like $45 billion. Like Uber, if you were to parse out Uber right now, it's like 125 billion EV. You could put maybe 60% towards the ride sharing business, 40% towards the delivery business. So if you even do that, like 60% on 120, what's that, like around 70 billion EV? And then half the business is international, half is the US. Waymo scaling up right now is only in the US. Scaling up in Europe is going to take way, way longer. Because of regulatory reasons. Like Uber's been illegal in the UK for years, and that just in their existing model. So to go to autonomous is going to take a very long time. So then you like break it down, like the overall, like Uber, there's a lot of value in Uber. It would not surprise me if people turn and view like, oh, Uber's platform is actually going to be like very accretive to these autonomous players, and there could be a rumor that Waymo at some point buys Uber. But I think it's just going to be like continuously executing against the numbers that they've laid out will be the biggest driver, similar to like a Google ChatGPT situation where people are still saying, is ChatGPT going to like hurt Google materially and over time? And that was something we talked about a lot a year plus ago, and it's still talked about, but the stock results have been strong, and so the stock has kept going. So that's my guess is what the path will be. But we'll see. Anyways, all right, so we're over time. Thank you so much for your time. If you have any questions for myself or Brandon, feel free to reach out. The last time I'll be saying this, Founders Class closes at the end of the year. So, you know, if you want to invest, reach out to me and we'll set you up with the docs. And have a great holiday season. I hope you spend time with your family, have a lot of fun. I will be going to Great Wolf Lodge and going down some water slides with my kids. I encourage anyone with small kids to do the same because it's a lot of fun. But I'll see you guys in the new year, and thanks so much for your time today. All right.